So far, every difference between book and taxable income has been a matter of timing. The IRS gets there sooner or later, but it always gets there. In this lecture, we meet the exceptions, items where book and tax simply disagree forever. These are permanent differences, and the accounting for them is refreshingly simple, but only if you put them in the right place in your reconciliation. Buy a municipal bond and collect the interest. It's revenue in your books, real income, real cash. And the IRS will never tax it. Not this year, not next year, not ever. Congress made it tax exempt permanently. So here's the question. If a difference never reverses, is there any future tax to defer? And if there's nothing to defer, what happens to our deferred tax machinery? Let's put the two types of differences side by side. A temporary difference is a difference in when. Total income over the item's life is identical for book and tax. So every temporary difference creates a deferred tax asset or a deferred tax liability that lives exactly as long as the difference does. A permanent difference is a difference in whether. The item appears in one system and never appears in the other. No reversal, no future tax effect, and therefore no deferred tax, ever. A permanent difference never touches a DTA or a DTL. Let's look at the classic examples in two groups. Group 1, in book income, never in taxable income. Municipal bond interest is the flagship. Life insurance proceeds that a company collects on a key officer, so think Elon Musk or Jeff Bezos. You would book the gain, but it's never taxed. And then the mirror image of expenses. Premiums that the company pays on that same key officer life insurance, so the life insurance expense, when the company is the beneficiary, it's a real book expense, but the IRS will not let you deduct it. Fines and penalties, deduct a parking ticket, the government isn't going to subsidize breaking the law, so that's permanent. Expenses of earning tax-exempt income fall in the same bucket. Group 2, in taxable income, but never in book income. These are rarer and they're usually gifts from Congress. The dividends received deduction lets a corporation exclude most of the dividends that it receives from other U.S. corporations. Percentage depletion lets some extractive companies deduct more than an asset ever even cost. You don't need to master the tax law behind these, you just need to recognize them and treat them correctly. Now, the placement. And here's the rule. Permanent differences go first. Start with book income and remove them immediately. Subtract the municipal interest, add back any non-deductible premiums and fines before you touch a single temporary difference. I call the result adjusted book income, and it's the version of book income that the tax system actually recognizes as income at all. Why does the order matter? Because of what gets multiplied by the rate. Tax expense is adjusted book income by the rate, not raw book income. Think about why. Tax expense represents the tax that will ultimately pay on this year's book income, but the municipal interest will never be taxed. No expense now, no deferred tax later. It's simply out of the system, so it comes out of the base before anything else happens. From adjusted book income, the machine runs exactly as before. Apply your reversing schedule adjustments for the temporary differences, arrive at taxable income, multiply by the rate for payable, and let the deferred accounts pick up the temporary differences only. Here's a nice way to see the difference between the two families. Temporary differences never change total tax expense. They only move tax between current and deferred. Permanent differences change the expense itself, which means they change the company's effective tax rate, tax expense divided by pre-tax book income. A company with lots of municipal interest reports an effective rate below the statutory rate forever. Analysts read effective rate reconciliations in the tax footnote for exactly this reason. And now you can too. Permanents move the rate, temporaries just move the timing. Let's look at an example of permanent differences and temporary differences in the same problem. This time we're going to look at the same company, except we're going to look at 3 years. They've been given book income, and we also are told what the permanent differences are and about one temporary difference. So first we'll treat the permanent differences in our reconciliation to get adjusted book income, and then we'll handle the temporary differences to arrive at our journal entry. All right, before we get started with our reconciliation, we need to build our tax versus book reversing schedule for our temporary difference. And in this case, we've got ourselves a machine that has a useful life of 5 years and a double declining balance rate of 40%. So we're going to take the in order to figure out double declining balance, we're going to take that $250,000 machine and we're going to multiply it by the double declining balance rate, which is 40%. And I know that because the straight line is 5 years and 1 over 5 is 20%, and 2 times 20% gives us our double declining balance rate. So that first year, I'm going to take 40% of the $250,000 and I'll get $100,000. So that's my deduction, my tax deduction in year 1 for this machine. And straight line, however, is the 5 years evenly divided with a residual value of $25,000. So I'll take that 250 minus 25 and divide it over the 5-year useful life, which gives me a expense for depreciation of $45,000. Notice in double declining balance, I did not subtract the residual. You do not subtract the residual in double declining balance. The math doesn't work that way. And you just depreciate it until all you have left is the residual. So the difference here is $55,000. So I am going to be deducting $55,000 more dollars in depreciation expense on my tax return than I am putting on my income statement. So building this schedule out, I'm going to have $60,000 in year 2. And in year 3, I'll have 36. If you'd like to see the math on this, it's available in the solutions file on Canvas, but we're just applying 40% to the remaining balance each year, except in the last year, which is a plug to make sure that all we have left is our residual. So 7,400 is the final year. But I have 45,000 in each of the other years at my straight line rate. So that reversing schedule shows me that I have a growing DTL here that is going to mean in the future it'll start reversing. And you notice that it doesn't actually start reversing until year 3. In year 2, it's still growing. I'm still got book income that's greater than taxable income in the first 2 years. And then it starts reversing here in year 3. So when I go to build my schedule for year 1, I'm going to start with book income, and they gave me book income of $500,000, and I'm going to first add the permanent differences. Or subtract, depending. So first I received $5,000 of municipal bond interest that would have been included in this book income amount. I don't have to pay tax on that. So I'm going to subtract the interest of $5,000. And then the $10,000 non-deductible life insurance premiums, I would have recognized an expense to arrive at that book income. I need to add those back, insurance premiums, because they are not deductible. So I can't offset my tax with that amount. So now I have my adjusted book income of $505. And this is what I'll use to calculate tax expense. This is what I'll multiply by 25% here to arrive at $126,250. Now I can adjust for my temporary differences, and that is the depreciation. So remember, I need to subtract an additional $55,000 I could deduct on my tax return, which means taxable income is $496,000. So I'll apply the 25% rate to each of these. Now, if that $55,000 was going to be reversing, it's going to start reversing in year 3. Notice if there were a different tax rate, I would need to use that tax rate here instead. But I don't know of one, so I'm going to use this 25% rate. And I would get a $2,250 DTL, and my taxes payable would be $124,000. So I can build my entry from there by debiting tax expense. This would be a debit, this would be a credit, and this would also be a credit taxes payable. Now in year 2, I'll do the same thing. I'll start with book income just like I've done here, and I'll add my municipal bond interest back, and I'll subtract my insurance premium. And instead I will subtract the $15,000 instead of this $55,000, and I'll arrive at taxable income. And I'm still going to be crediting a DTL in year 2. Then in year 3, I'll start debiting the DTL as it begins to reverse. To wrap up, permanent differences are disagreements about whether, not when. They never reverse, so they never create deferred tax assets or liabilities. Know the usual suspects and make sure they go first in the reconciliation. Book income becomes adjusted book income, and that is what gets multiplied by the rate for tax expense. Temporary differences shift tax between years. Permanent differences change the bill itself, which is why they move the effective tax rate.